This is our first all virtual Jane Project event because our wonderful speaker is all the way across the country. And we're really grateful to Matt for doing this today. We're going to learn about special purpose vehicles. So we learned about special purpose vehicles a little bit in our last Jane event, and our speaker asked the question, who wants to learn more about these? And everyone in the room raised their hand. So here we are. And thank you to Matt. A little bit of housekeeping. So this is going to be our last event of this season. We're going to take a couple months off over the summer and resume events in August. And during that time, though, we're going to be very busy. We're setting up our nonprofit 501c3 designation. We are going to be focusing on building out a content library in our Substack and some other good event and programming planning for the fall. So stay tuned for that. Next slide. Thanks. So we have a new little tagline that women belong at the cap table. Thank you, Caitlin, for writing that. It's so clever. And I'm going to introduce Caitlin in just a minute as more people are joining. And just a reminder, we're here because when women have access to capital, they also build impact. And we want to give as many women as possible access to venture capital. And that's what we're learning about. I have a really exciting announcement that on the path to becoming a nonprofit entity, we have partnered up with the Community Investment Corporation, and the executive director, Danny Nee, is on this call today. And thank you, Danny, for offering to do this. So having a fiscal sponsor means that we can now take tax-deductible donations through the Community Investment Corporation, which is an entity that supports underrepresented entrepreneurs. And we're very excited to be partnered up with them. And with that, we actually have our very first donor who is also joining today. I think she's on. Megan Duty. She is a venture investor, so she's a limited partner. She's also an angel investor, and she's an entrepreneur. And she is our very first Jane Project donor. And we are so, so grateful to Megan. Thank you again. And with that, I want to introduce someone who's been working really hard behind the scenes on all things Jane Project. Caitlin Fitzgerald is a marketer. She's an entrepreneur. She's a future venture capitalist, and she's amazing. And I'm going to let her announce our new website and tell you about some other stuff she's been working on. So thank you, Caitlin.
And thank you, Allie. Like a lot of you, I was so inspired from the very first Jane Project event that I was like, Allie, I want to roll up my sleeves and I want to get involved. So we're very excited to first, as you can tell, be unveiling our website. So you can now go to janeproject.vc to stay up to speed on all things. Are you guys able to see that screen? Okay, great. You can all now go to janeproject.vc to get up to speed on all things Jane Project. Couple pages in here I really want to direct you guys to. First is our join page. Our join page is going to include our sign up for updates, how you can subscribe, our link to our Substack, upcoming events, joining the Jane Project on Slack, and our social media channels. So you can start subscribing, following, and really getting involved. Like Allie said, while we're taking the pause over the summer, we're going to be really building out our content library and our ecosystem to give you all the information that you're looking for on venture capital in between these great events. So our website is a great place to go to make sure that you are in the loop and getting all of those updates as they are published. And it's another great place to go to spread the word, right? So if you have friends that are really excited about this type of thing and that you think would be a great fit for the Jane Project, we ask all of you to spread the word, and our website is a great vehicle for doing that. And for those of you that feel so inclined, you can also donate to the Jane Project through our website. We have a donation form that you can fill out, and we will be in touch with you with next steps for that donation. Again, thanks to our amazing fiscal sponsor. So we're excited for you to dive in. Our social media channels will be getting kicked off. We'll get a lot of content going in the next few weeks here. So welcome to the Jane Project. Welcome to this foundation for this movement that we're trying to build. And now we are actually here to learn. So I am going to go back right over here to our presentation because we have an amazing speaker today. Matt Curtolo is a seasoned investor. He has experience not only in the investment side, but also in the innovation side, bringing his experience as an investor to fintech and helping to launch his own platforms to connect private investors and family offices. So I'm going to let Matt share more about his background and actually pass the presentation baton over to you, Matt, so you can kind of take the driver's seat behind the deck. And we can all start learning about the amazing content that you have for us today.
Awesome. Thanks, Caitlin. Let me share my screen and we will dive in. All right. Everybody see that? We're good?
Yes.
All good. Okay. So maybe just a little bit more background on myself. Caitlin, thank you for the intro. I've spent the better part of 20 years now as an institutional investor. So started my career at what was a 10-year-old company that kind of felt like a startup. The industry of private markets was basically still in its infancy. So there was some appetite from large institutional type investors, think public pensions, think corporate pension plans, endowments and foundations. But it wasn't as commonplace as it is today, where I think you can turn on any news network, look at any social media channel, and hear things about innovation and venture capital and private markets at large. But throughout my career, I got to work with a variety of different institutions and wear a bunch of different hats. So it was large institutions. I worked with family offices, sort of individual investors, smaller institutions. I worked directly for an insurance company for MetLife for a number of years. So think of a Fortune 50 insurance platform with very different goals and constituents. And then, as Caitlin mentioned, over the last 3 years was the first non-founder hire at a startup called Allocate, where the whole premise was to bring more engagement, more investors, and more GPs, more managers into the ecosystem of venture capital. I'd say throughout that journey, I've always been looking to bring more adoption, more engagement, more eyeballs on what I found to be incredibly interesting. I grew up in a small town in upstate Pennsylvania, so about 90 miles west of New York, 90 miles north of Philly. And this was not an area that I had access to. So over the years, both in each of those roles, it was part of my mission to bring more accessibility to the asset class to just people who hadn't seen it. This outsider's mentality where I was fortunate to come in through the front door, be at a growing company, and have access to a lot of the great resources that I want to share with all of you today. But most recently, I've gotten more involved. So over the last year and a half, I've built my own consulting business where I work directly with managers, emerging fund managers, as well as limited partner groups that are looking to invest in venture capital. A big theme within all of that is underrepresented managers, right? When you think about equity and equality and inclusion in this market, it spans all shapes and sizes, right? I think when I met Allie for the first time and she shared the Jane project with me, I said, this is just such a perfect way that resonates so much with me to expand the aperture for not just the investor universe and the individuals and the folks like you on this call, but really for the economic development for the investors themselves on the GP side. So I'm thrilled to be able to join today and have an opportunity to chat with all of you. So the theme of this is SPV, special purpose vehicles. So I think the question is first and foremost, what is an SPV? Uh, the SPV is effectively a legal entity that's created to make one single investment. And that investment can be, you know, a single company, it can be a fund, it can be a collection of funds. It can really be in any underlying investment. But in this capacity, investors pool their capital into this single vehicle that has been created to achieve the special purpose that it's been created for. Um, Maybe one thing to think about is think of the SPV as kind of a group gift. And this is such a fun image. I was able to find this, but appreciate the help from the team on the branding here. But think of it as the group gift where everybody chips in, one person goes and buys the gift, and then everybody gets credit for it. right? So that's definitely a net positive across the board. In the venture capital context that we're talking about today, investors are going to pool their money. The SPV is going to make an investment, and investors then own. We're going to use the word pro rata. That's just effectively their proportionate amount of the SPV. So if you put in $1 and the SPV was $100, you own 1%. 1% is your pro rata or proportionate ownership of the SPV itself. So when you think about why an SPV exists, there's benefits for both the investor and I'm going to use the word sponsor here. I'll define it in a couple slides. But the idea of the sponsor is the person setting up the vehicle. So for an individual investor, the minimums, if you're investing in a venture capital fund or even a company, are oftentimes really high. So it could be 7 figures or more to make just one investment into one fund or investment. So what SPVs do is they open up the access to what I believe are high quality opportunities without the requirement of that huge commitment up front. And that's been a big barrier for a lot of folks. There are a lot of reasons why people have not invested into funds or into venture capital in the past. A big part of that is the initial capital commitment that's required to invest in these funds. The other piece is I think this deal by deal decision making framework. So an SPV is formed for the intended purpose of investing in something that has been pre-identified. So as an investor, you get the access to the deal and the benefit of knowing what that deal is up front. So you get this deal by deal decision making component of really what you're seeing. Beyond that, when you think about the access, if you don't have to write such a massive check into one single investment, it gives you access to more deals, right? You can take that, what would have been big financial commitment, and spread that across other deals. So it gives you more access. The SPVs can look and feel very different, but you have both that deal by deal decision making and you get access to more and that financial requirement. Yes. So the other piece of the investor benefit is the administrative ease. So we'll talk a little bit about how the fees and the reporting go with an SPV, but the reality is investing in a fund, investing in a number of funds and all the other formats, there's a little more complicated, both subscribing to the vehicle itself, actually signing the documents to get you into the vehicle, as well as the ongoing monitoring and reporting on that vehicle. So with an SPV, it's a one-time investment. You get investments and documents based on that single investment. So it's a lot more efficient than what you would think of in the other contexts. But you might ask on the flip side for the sponsor, for the person setting up this SPV, why are they doing it? This is really important for this group today and in the groups that I work with a lot. The world of capital providers is actually getting smaller. So if you think about the endowments, you think about the traditional folks who invest in venture capital, these are groups that have either been investing for many, many years, have maybe a target allocation that they've reached, and they're continuing on their what we say re-upping with their existing investors or existing firms, and maybe not providing a lot of net new capital to new entrants in the market. What we see as the next frontier from an investor base is what we call as retail or institutional retail capital. It's not, you don't have a Robinhood app on your phone and you can buy a share in a venture capital company. These are still all private, still is all privately negotiated. But what you can have access to is things like this SPV. And that group is completely untapped. So from a sponsor's perspective, they're looking for new sources of capital, access to new investors, and it allows them to diversify away from some of those existing, what I'll call legacy investors that may or may not be going through their own challenges. If you read the headlines and think about what's happening in a lot of the high profile Ivy League endowments or, across other foundations, those are challenges. Public pension funds are facing their own, and then you have idiosyncratic events that may or may not change what a big pool of capital may or may not do. So from a sponsor, they get access to a lot more eyeballs, and they have folks that are new to the industry that they can then source future investments from. So it's great for them to get the appetite met by a new group of investors versus what they had done traditionally. And it is a lot more efficient operationally. So back to the point for the investor, it's administratively easier. For the sponsor, they get so think about you have to set up a legal agreement. You then have kind of the operating efficiencies. You can set that up quicker. It's lower cost and probably fewer compliance hurdles. I won't get into the weeds on how these get set up, but this ability to kind of build that out is really important. So both sides benefit from more efficient operations. And really, when you think about the SPV, this is an opportunity for the investor and the sponsor. Both of them want to find each other. So this gives them a conduit to get together, uh, new source of capital for interesting deals, efficient decision making, and lower minimums. So it really is a win-win across the board, which is rare in this industry. Uh, I do want to take a step back. There's a lot of words on the page. It's thinking about what can go into an SPV. So the SPV we said can be generally set up to make an investment, a specified investment. So as the investor, you know what you're investing in. That's partially true. If that's all the way on the right here on this table and you're investing directly into a company, yes, you know exactly what that company is, the information around it, and that's sort of this true full transparency. So the benefit of going into an SPV for a direct company, for writing an angel check into a company, is you get that transparency, and the outcome could be fantastic. The challenge for those angel investments, which is where a lot of us started, is you don't know what you're seeing, right? You don't know how many deals you're seeing. There's potential for adverse selection. There is a lot of single company risk that's embedded in whatever the company is pursuing, the business model, the technology, the team. And if you look at the data, there are a lot of studies out there in the earliest stages. Those angel investments, let's talk about a pre-seed or a seed stage company at inception, 60+% of those return $0. So there's a high probability, a more than 50% probability that you're going to lose that investment. So you have high upside, you have transparency and visibility into what you're investing in, but it is taking on the highest level of risk. But that is kind of the purest form of the SPVs when you think about the world. What I want to focus on today is a lot more about the middle column, the fund commitment. So when you think about what a fund commitment is, it can still be wrapped in that SPV, but what that's going to give you is a bit more diversification. So a fund is going to have, it can range anywhere from 10, 15, 20, let's say 20 to 40 companies in that fund. So that gives you diversification, and you get still the return potential for those companies to generate positive outcomes. What you do start thinking about in this context is it is a blind pool. So let's say we support a manager who has an idea and a strategy. That manager then is going to have to go out and find those companies. So what you're investing in that SPV is really giving that manager the bandwidth and the capital and the leash to go out and execute that strategy, find and invest in those companies, but you don't know it on day one. So that's where we overlay then how do you make the decision on what to do? We'll talk about it in a little more detail in future slide, but you have to do a lot more qualitative due diligence. And that's really understanding who the people are, why they're doing what they're doing, understanding the why and the how. I always say I'm just trying to get at the root of that, because you don't have the level of transparency as you would with a single company. That can even go further. So I include on the left a fund of funds. So an SPV could be a wrapper for a vehicle that then goes and invests in funds that then go and invest in companies. So think of that as two layers removed. That's going to give you the most diversification. It's going to give you access to a lot more deals. But what you're going to trade off is, it's going to dilute any of those outsized returns.
And Matt, I think I see a couple questions coming in.
Sure. Let me.
Would it be easy? I could read them to you if you want.
Yeah, if you don't mind.
Yeah. So for the first one is, what's a typical check size into a venture fund versus a typical check size into an SPV?
So it's a good question. I think the venture funds can vary. I'd say in most cases, It's going to be at minimum $100,000. In most cases, it's probably in the 250K and above. The more institutional or really the larger or more mature the fund gets, those start creeping into the, millions. In the most institutional funds, you might be talking of tens of millions. But I'd say 250 is probably a number that we can point to for a venture fund, for a small emerging venture fund. In the case of an SPV, that could be as low as $5 or $10,000. And a lot of this depends on the sponsor and the GP themselves. But in most cases, you're talking a fraction of what you're doing into a fund into an SPV. That's not an upper limit. You can still commit the same amount into an SPV as you would a fund, but the minimum required is much lower.
So it's a much lower barrier to access to getting into a fund.
Exactly. That's the one of the features we talked about on the last slide was really focused on, you know, it, many investors see that number in their first investment they're going to make, and it's a big commitment, right? Or regardless of your net worth, that's still a big dollar amount to put into your first investment. So the SPV, kind of think of that as a mini step into the asset class. It allows you to take less financial risk upfront, uh, and gets you access to perhaps the same or even better quality.
So, how do you feel about one more question before
Yeah,
moving
let's
on to
do
the
it.
next? Okay. So we have heard institutional investors prefer to invest in the management company rather than the SPV. Is that accurate?
It directionally true. I think the institutional investors, they're looking for a number of different things. One, being able to have a little bit more voice and visibility. So if they can go directly onto the cap table, they then may get some information rights or observer rights or whatever that might be sitting within the company, sort of within the four walls on that cap table. It also comes with a higher duty of care, right? You have to be a lot more involved and engaged than you would be if you were in an SPV. So I'd say if you think about the larger institutional investors and maybe even kind of the mid-sized groups, they're going to look to make, we say co-investments or direct investments. They'd like to be involved in some way as close to the company as they can. Now, in a lot of cases, that is through an SPV structure. So the sponsor, the manager will set up that wrapper to allow all of the potential co-investors, direct investors to efficiently invest in that company. Because as a founder, do you want all of these investors on your cap table to own a small share of the company directly? That also comes with reporting requirements and things like that. So in many cases, if the deal's big enough, the sponsor will put together an SPV just for efficiency purposes. But I think the large institutions sort of going around it a bit, but their preference would be to be as close to the company as they can.
Awesome. Thanks.
You got it. Excellent. So why don't we go to the next slide? We'll talk a little bit tactically about how it works. So, if you think about what we just talked about, the sponsor has an idea, has a fund, has a portfolio, has a company, pick it, has an investment, and they want to set up an SPV to raise money to invest in that. So that's step one. The sponsor has that idea, kind of figures that out. Then the fundraising process is them going out to their network of investors. Uh, could be broad, could be limited. They could have existing investors in their portfolio of their funds, whatever it might look like. They're going to reach out and start to actively fundraise for the amount of capital that they need to invest into this project. As an investor, then it's incumbent on you to complete your due diligence. We'll talk about due diligence in a couple slides, but once you're presented with an investment opportunity, you want to make sure you understand what you're getting into, what you like about it, if you like it, really get yourself to the point of conviction where you're ready to invest into that SPV. So once that fundraising process is complete, the investors have done their due diligence and made the decision to put capital into the SPV. The SPV then is closed and it completes that investment into, could be a fund commitment that then ultimately goes and finds other companies. It could be directly into a company, but that completes that investment at that point. And the investors, we talked about this before, they receive their prorated share, their pro rata share of the SPV based on the dollars that they put into the total size of the vehicle. So it's just the proportion that they own. And let's hope everything goes well over a period of time. That company, those investments generate profits. Those returns then flow back to the investor in the form of distributions based on their prorated percentage of the total. So it's pretty much a straight line. Those dollars can then be reinvested. You can kind of do whatever you want with those at that point, but that's the life cycle of the SPV. We talked about operating efficiency and simplicity. There's not a lot of steps, whereas sometimes with larger investors or other structures, there might be a little bit more noise within this. So it's pretty streamlined. It is to the point made before. It allows you to get into some really interesting investments without having to commit those big dollars, time, or have to go through your own process of sourcing and diligence. So, we talked about this a little bit, but the sponsor, it's kind of a fancy word. It can be really any person or entity that's setting up the vehicle. This could be an independent agent, broker, someone who, has secured access into a particular company. It could be a fund manager. It could be a financial institution, a bank, insurance company. The sponsor is just the entity or person that's really putting this together. So think of sponsor as in its truest form, it's the person responsible for setting that up. The investment due diligence piece, I want to spend a little bit of time on this because this is something near and dear to my heart. I've built a lot of programs over the years at institutions where you think about what are the multitude of questions that you could ask people about the investment before you're able to get comfortable with it. That could be a company when you're talking to the founder and the management team. That could be a fund where you're talking to the general partner, trying to understand what they're building, why they're building it. Um, what your goal is to get to a point of conviction that you can make that decision to invest or not invest. But you're generally starting from a pretty blank slate. So I lay this out with the 5 W's and the H. So who is the sponsor? It's not just identifying who they are, but it's looking into their background. Are they well suited to be doing the thing that they're doing? Right? Are they in a position that this suits their core competency? Do they have the right background? They're thinking about things in a way that aligns with how you believe the company should exist and what will drive success there. Also, then understanding the what. What is the company and the business, the fund, whatever it might be? You have to have a good understanding of what's happening there. And I will say a big challenge with folks is there's a level of opacity in some of these companies and offerings where if you don't ask the questions, you may not have a full picture of exactly what that business or fund is executing. So, these sound simple, but these are a lot of things that people overlook when they're presented with an opportunity. With the person who showed me this is really smart. It sounds really interesting, but kind of going a layer deeper to understand at least just the who and the what, that gives you, okay, how do I feel about this at stage one? The timing and structure, that's a little bit more tactical, but you need to understand if something's happening in 3 days, is that gonna give you enough time to consciously evaluate and get to that conviction point, or is it just too tight of a timeline? And in the structure, we'll talk a little bit about fees and economics next. Are the financial terms of the agreement favorable to the investor, or does it feel like there's a lot of people putting their hand out and getting their palms greased as you continue to make this investment happen? The last 2 are the most critical, right? As you could guess, why? And why is not an easy answer. It's why will this investment be successful? So when we were building investment programs institutionally, we kind of called these need to believes. So what do you need to believe when you look at these investments that they're going to be a success? Is it something about the market? Is it something about the people? Does the sponsor have a particular orientation in a market? Are they in a geography? Do they have a background? What are the things that are driving why the success of this company or investment is going to come through? And then having that in your head, you're going to test that thesis, right, through all of this. Do I believe this? How strongly do I believe this? What can I do to get myself a little more comfortable with this? And how, right? How will this sponsor help achieve that outcome. So you're looking again at the same question base of really what are we doing? What are we trying to build? How likely is it to happen? What I will say is from an institutional perspective, I was generally armed with enough time, a team of resources, and some capital to put into research there. In most cases, when you're investing in an SPV, you don't have any of those. You may have some, but in most cases, you're going to be running this process independently. But so it's really important to think about these in the right context. But what you also want to do is make sure you're not holding yourself to a standard that you're not going to be able to find the answers to all these questions. So, as an investor, think about what's the most important thing for you when you invest your own capital into a company. Can you get the visibility and transparency to get some of those questions you might have answered? And then, beyond that, what is really the gating item for you? Is it who the sponsor is? Is it what the company does? Is it how coherently they can tell that story or I can understand the story? There's a lot of ways you can slice this. I present it in a much more of an art than a science. So that's really where you end up coming in with this piece of it is often overlooked by a lot of folks. It's underweighted, particularly in the SPV market when there's a high velocity and people are asking for, let's fill out documents and get this done by the end of the week. Resist that urge. My single piece of advice is just make sure you understand what's right for you. This is your capital. When you're putting this into a company or an SPV investment, you want to make sure it's the right thing and you've done the work that gets you comfortable with it.
Matt, can I stop you with a
Yeah,
couple more questions?
for sure.
Okay, so this one is, can anyone sponsor an SPV, and does the sponsor need to be an accredited investor?
I I think the answer to the first question is yes. Anyone can set up an SPV. You have to go through a simple registration process and then raise the capital. Technically, I don't think you have to be an accredited investor to set that up. I don't know that 100%. So my sense is that anyone can set up an SPV. It doesn't have to be because you're an accredited investor. It's really comes down to your ability to raise that capital and then fill out consummate the investment. Now, the underlying investment or fund may have guidelines, so the SPV can't obfuscate if only accredited investors can invest into a fund. The SPV needs to be viewed as an accredited investor to be able to carry that through. So
Got it.
the underlying investment's gonna dictate who can invest in the SPV, but for the most part, I think anybody can set that up.
Thank you. And the next question is, where do you see the SPV model evolving over the next few years, especially with platforms making it easier for solo capitalists and angels?
It's a fantastic question. I spent the last 2.5 years of my career at a firm that was effectively using this model to promote more access. So I'd say that was the tip of the spear. As we used at Allocate, we used SPVs to build feeder funds effectively to go into other funds. So it was that step I think is just going to continue in different waves. So whether that's going to be SPVs to go into larger vehicles to portfolios of funds, we're going to continue to see more and more efficiency in that space. The point around tech platforms making it easier. There are dedicated platforms now where you can sign on, you can look through a menu, you can click through, go through your, accreditation. You have to validate who you are, the KYC process, the know your customer process of proving that you are who you are, and then the funding requirements. But it's pretty straightforward now with the platforms that just exist today. So my view is there are more and more of these that are going to continue to pop up. They're going to focus on different areas. There are ones that focus on a particular sector or space. There are ones that focus on much, much lower minimums that might be $1,000 to be able to invest. So I think you're going to see a proliferation of platforms that enable the retail investor, the individual, to be able to get access to something that they never had before. On the institutional end, I think it becomes uh, a little bit more nuanced. Like back to the question on like do the institutions really want these to exist? Do they need them when they can have direct access into the companies or the funds? So I think you're going to see most of the uptake from the retail audience or from the individual private wealth space. And then the institutions will be pretty selective, I think, as they are today, in terms of using that uh, to meet specific needs in particular companies that they're thinking about.
Great. Thank you.
Excellent. Great questions. Keep them coming. So we talk about the vehicle, we talk about the process. The economics are something that you have to pay attention to, right? You're not getting into these. It's not like buying an ETF or a share of stock where there's a small commission and it appears in your brokerage account. When you think about the SPV, there are a couple different fees that come into play. The carried interest is the one that's pretty customary. I think most SPVs will have some carried interest component. And that's just the sponsor's share of the profits, right? Traditionally in the market, it's 10 to 20% of the profits. So think about $100 SPV that returns $200. The investors get their whole 100 back, and then the investor will get 80 or 90% of that. The sponsor gets 10 to 20% of that gain. So think about the carried interest. There has to be something in it for the sponsor, right? They're bringing this opportunity. It's not necessarily a finder's fee, but it is their reward for a successful investment that you're able to participate in. So assuming everything goes well, they're going to share in the upside, which when you think about it that's the best alignment of interest you can have. If it fails, they don't get anything. But if it's profitable and successful, they get a share of that. So I'd say if you start seeing layers and layers of carried interest of this person gets 5%, this next person gets 10%. Start to consider that. It's something that probably is buried in a legal agreement, so it may not be as obvious, but that's one thing to just think about how much of the upside are they entitled to, and market standards kind of in that 10 to 20% range. The other fee that is pretty customary is the admin fee. So because this is a legal entity, there's setup costs. There's, in most cases, these aren't audited positions, but they do have tax. You have to do a tax preparation around that if there are profits and losses that are coming in there, and potentially some reporting costs. A lot of times, the admin fee is structured as just an upfront cost. Maybe that's 1 or 2% of the total transaction, but then it's not an ongoing fee. So they kind of bake in all the operating costs to manage the SPV at the outset, take that capital up front, kind of put that into an account. And, those two fees, the admin fee and the carried interest, when you're presented with an SPV, those should both be pretty clearly shown by the sponsor. And it's definitely something you can ask if it's not there. The management fee is something that's, sometimes shown. I would say when the SPV is more of a fund or a fund of funds, where there's some kind of oversight that's required by the sponsor, there may be an incremental management fee because there's an ongoing need for them to take a look and oversee what's happening within that portfolio or program. If it's a single company, yes, there is some level of oversight, but with a fund or a fund of funds, there's a bit more from the sponsor. So you may see a layer of management fees that comes onto the SPV. Those underlying funds will have their own management fee and carry. So those are this would be in addition to that. So not customary, but something to keep your eyes on. These can get pretty expensive if depending on who's marketing them and who the sponsor is and how that's coming to you. So this is something to definitely be aware of. Nothing is free in this market. The best opportunities, I can tell you the number of times I see an opportunity to invest in SpaceX that passes my desk on a regular basis, saying nothing about the company, but the number of people who are shopping effectively the same deal across the board with a boatload of fees on top of that gives you pause, right? So there are a lot of people who are looking for that next deal, the hot deal, and they're trying to find somebody to take that bait. This is where, I think you can do all your investment due diligence and say, okay, this company makes sense. I understand what they're doing. I can get behind it. But when you look at the economics in a lot of these cases, they're fairly rich towards the sponsor. So you want to make sure that you're comfortable with the economics. We talk a lot in the investment world about gross of fees and net of fees. Net of fees is the only thing that hits your bank account or your pocket. So the gross returns are all happening before any of these economics start to play out. So make sure you have an eye towards, what are these fees? What am I paying? Is it reasonable? Does it feel reasonable to me?
Hey, Matt, there really quick, there's a clarifying question. Do I understand correctly then that it would be double the interest and fees when you take the SPV route as a fund of funds? And oh, I think those are two separate things, Sydney. And you consider that the price to play. So I think what Sydney's asking is, are the fees double for a fund of funds versus a traditional investment? And also for an SPV, is that what you mean, Sid? Sorry to make you go off mute.
No, that's okay. It sounds like you pay it once to the SPV and then you pay it again when it goes to the fund. And then the second comment is just then you consider that as like if I was someone who couldn't meet the minimums to go into a traditional fund, then that's just the price I'm willing to pay to participate. Is that the right way to think of it?
Yes, Simi, that's exactly right. I think the fund of funds, you are paying an extra layer. They call it the double layer of fees because that fund of funds managers is effectively providing you the access into all those underlying funds. So there are multiple layers of fees that have to roll up. On the SPV, in a lot of cases, if it's going into a fund or a fund of funds, the SPV may waive some of those fees because those layers are coming on there. But it is the price to play in terms of that. You get the access, but for the access fee, which could be the upfront fee, the upfront management fee or carry that you have to pay on that. The carry is definitely more something you see with direct companies, right? Because there isn't a fee attachment to that. With a fund, there are other investors that are paying a management fee and a carried interest that then extend to the SPV. So in most cases, the SPV sponsor is probably not going to take much, if any, carried interest on top of that. It's a good question. Thanks for clarifying that.
So we have other questions coming in. And I know you have other slides, but I just wanted to summarize what you just said from a fees perspective. It sounds like a fund of funds is the most fee heavy um, structure for an LP, followed by potentially an SPV, followed then by a direct fund investment. Does that sound right?
That's exactly right, Ali. I think the fund of funds and think of it in the service you're getting to with the direct company, that's going to be wrapped in an SPV. You're effectively paying for access once, and then there's a carried interest component if that is successful. So it's as straightforward as you can get. With the fund, you're effectively paying for someone to go out and find companies and invest in those in a collection of those. So you get the benefit of the diversification, but that fund manager, that sponsor in that case, is going to need a management fee and a carry to make it worth their while. So if you wrap an SPV around that and the sponsor is not the same as the fund manager, there may be an incremental tick that they would take from a fee perspective to make, for them to provide the access service to the end investors. And the fund of funds, the service layer of that from, again, the SPV provider would be setting that up, providing it to folks. The fund of funds manager, the fund of funds GP is going out and selecting the underlying funds. Those underlying funds are then still collecting that. So it is, in that case, if it's an SPV wrapper around a fund of funds, it is potentially 3 layers of fees. So definitely something to consider. But what I've always told folks is if it's something you can do yourself, contextualize the management fee. Like, is this a fee that I'm paying for a service that I otherwise could not get? I think Sydney said it well. It is kind of the price to play. You're not just going to be able to invest in these for free. There is an access point that you do have to find and then be willing to pay for.
Got it. Thank you.
Yeah, absolutely. Just one more slide, and I think I always hate to end on the risks and considerations, but it is something I always tell folks, venture is not for the faint of heart. And I know you all have been talking about this within the project for a while, but venture as a whole is the riskiest end of the equity investment spectrum, right? And then if you think about pre-seed and seed companies, those are the earliest within the riskiest piece of the market. And that stat I quoted before, the number of companies that fail at the earliest stage is real. It's the majority of companies that are formed that raise capital don't make it 18, 24, 36 months. So take that into consideration when you think about this is a higher order question or thought, but when you think about your own asset allocation, how much money am I going to invest in venture? Because I have to understand going into that, this is money that could go to zero. That's not the same consideration that you have when you're investing in the S&P 500 or other type real estate or other types of investments. Venture is the place where I think you do see the widest dispersion of outcomes with a floor of zero. So always keep that in mind. It's not meant to be scary because there's fantastic outcomes that come from this. But when you think about it in your portfolio context, make sure you weight it to a point that you're comfortable that if this money goes to zero, it doesn't change the entirety of what you're doing. Illiquidity
Eh,
is the other piece. Oh, go ahead. No.
No, sorry, go ahead, please.
Yeah, I was just going to say that the illiquidity is the other piece of this. So the risk, but let's say you're investing in an SPV that's investing in a fund that's investing at the pre-seed stage of a company. So these companies are, at inception, it's going to take them looking at some market data, anywhere from 8 to 10 years to get either to a public market exit, to be acquired, or to really generate an outcome for you. So not only do you have to think about am I okay if this money goes to zero, but am I also okay with not seeing this money again for 8 to 10 to 12 years? So it does have a real timeline based on the stage of company that you're investing in or the stage of fund. So making sure that you're comfortable with the liquidity, with the risk profile. And then because these are private companies, they don't, you can't search them online. You don't see the price or valuation. What you get is a quarterly statement generally. And in some SPVs, you may only get an annual statement that tells you the company's value, the value of your position. It may be 1 or 2 pages. So making sure you're okay not being full with a lack of transparency in some of these cases. It goes back to that point of initial due diligence of what you want to do and how you get comfortable with it. So all these things are, I think the risk profile and the illiquidity are things you think about venture as a whole. And then the controls and the transparency is something that, yes, you have to understand that these are not public. These are not companies that are going to report all of their financial information. So just being comfortable that you can kind of let that ride. You will get some, but also a question you can ask up front when you're making that investment. So sorry to end on the risks and considerations note, but I'm happy to answer more questions.
Thank you for ending on that note, actually. It's always an important reminder. So we do have questions coming in. What are the main signals you look for before deciding that an opportunity is a strong fit for an SPV rather than a traditional fund investment?
You know what? The truth is, if it's a good fund investment, I think it can be a good SPV investment. In a lot of cases, the converse is not true, and I'll explain that a little bit. But if you think about what the SPV is really providing, it is an access layer or an access structure for more folks to be able to invest in that. So fundamentally, the fund investment has to be of a quality that you're really going to be confident and comfortable with. And the fees and the terms around that SPV hopefully don't change that too much. So that's the case where the fund investment might be great, but if the fees are onerous or the structure isn't something that you can really wrap your arms around, then that could become a less attractive. Yeah, I'd just say that the terms are the way that you can kind of figure out that can make one of them more or less attractive. But if you have a high quality fund investment, generally the wrapper is not going to change the quality of that underlying investment. Whereas, the fund investment as a standalone, I think it remains a good investment. So it's just, if you have some of those terms and the economics that don't make sense, it could make the SPV less attractive than the fund.
On that note, is there a certain deal size that is optimal for an SPV versus a direct investment?
I don't think so. I would say it again comes back to what the sponsor wants to accomplish. It's if the I've seen SPVs raised at, you know, 50 or $75,000, right? You then bear a little bit more because there's a fixed cost associated with it. But in some of those cases, they wanted to pool money together to be able to, meet that financing need. So I wouldn't say there's a minimum that says you can't do it. You want to get it to a place where that fixed cost is not going to unduly burden the potential return of that fund. So I'd say it depends what those fixed costs are. In a lot of cases, it's single digit thousands. So if you have a $250,000 SPV and your fixed cost is five or $6,000, that's not going to materially impact the potential outcome of that SPV. But in most cases, I mean, you've seen SPVs in the hundreds of millions. You've also seen SPVs at as low as the, five figures. Optimal size, if I say like what's the run of the mill SPV if you go into one of these platforms, it's probably in the single digit millions and maybe the high hundred thousands. So somewhere from in that range is I think where a lot of folks are doing that. Writing an individual angel check is or a direct investment, I think is a little bit different because the company has to be open to having a lot of line items of small checks. So that's where I think they're going to dictate. Okay, if we have one or two people who are going to write sizable enough checks that we're going to welcome them onto the cap table, that's great. But if we really are going to try to bring 50, 60, 70 individuals into this, that's going to be much more of an SPV product than a direct cap table investment.
Got it. And another question, what is
Mhm.
the difference between a SPV and a syndicated deal?
Think of the SPV as just the structure. So a syndicated deal could be done through an SPV or not. But the SPV is really just the vehicle and the structure by which the investors are going to get access to it. When I think of the word syndicate, effectively someone's making that investment and then selling down a portion of that. So they're taking up $100 million of a fund or of an investment, and then they're going to find other investors to take some of that exposure away from them, and sell down some of that exposure. So the syndication process is not dissimilar to what I described with an SPV, where there's an identified opportunity. As an investor, you're going to have the opportunity to invest in that deal, and the SPV may or may not be the structure that you choose for that.
Um, do you see SPVs more in any particular industries versus others? Like, are they showing up more in tech versus B2C?
I I think it's become more universal. I think it started with more B2C, a lot more direct to consumer. There was a platform, gosh, maybe 10 years ago that started with SPVs in the consumer space, was mostly branded. And it was, the individuals felt a little more connected to those products that they were users of, where I think it was less the hard tech and the healthcare and the other areas of the market that were a little later to join. But as platforms like AngelList started, and now you have a number of these other platforms that are available, I think it's pretty diverse across all of technology. That's not to say that there aren't still consumer deals on there. There's not hard tech and space deals out there. I think the appetite is the supply and demand is getting balanced. So I think the demand is huge. So sponsors see this, so they're more than willing to put up an SPV regardless of what industry or sector they're focused on.
Great. Um, Follow-up question. Is that in that same spirit, do you see more SPVs in impact investing because folks feel more connected to the mission and a sponsor can really support around that impact?
So, great question, and I think short answer I would say is yes. The reality is, institutional capital is looking for certain markers and looking for certain size thresholds and looking for more pedigree, perhaps. A big part of why I do what I do now is to bring more eyeballs to these smaller and emerging managers that are just outside of the purview of some of these institutions. The more you can connect with the new and emerging LP base, the investors, the better. And I think impact is a great way where people are more than likely, if they're interested, already putting philanthropic capital behind it. That if you can allow them to do this through an investment vehicle that they are already connected with, that I think that simplifies a lot of what they have to do then. So yeah, I have seen a number of those, and I think it's the heart of that issue, or the heart of that reason is people are more connected to it. Individuals are more connected to it.
Great. And as more people are thinking, especially women, thinking about raising funds at some point, being fund managers, uh, do you believe that SPVs are a good way to start down that path? That women can start by sponsoring an SPV to gauge some interest and build credibility before raising a fund?
It's definitely that mini step we talked about, not just for investors, but for folks who are looking to start a fund. I'll take myself, for example. When I was looking for a new investment as an institutional investor, I wanted to see some level of track record and history of what have you done? What qualifies you to raise this capital and to go out and execute? So if you can prove some of that with SPVs, that's fantastic, right? It builds a muscle in terms of fundraising, which is not people's most comfortable suit, most people's most comfortable suit. So that fundraising process, understanding the mechanics, understanding how to find a deal or an investment that comes through there, being able to articulate your unique value add, why you're going to win, those questions I talked about in the due diligence section here. That's a really good start, right? And I think if you can raise that capital and then deploy that into whether that be deals themselves or a small collection, a small fund to do a handful of deals, I think that's fantastic. It's a great way. It's a lower barrier to entry for those folks. So I think, yeah, absolutely.
Fantastic. Any more questions for Matt? This was a great session, Matt. Thank you so much.
I'm done. Thank you for all the engagement. I really, it's some of these. It's a slightly technical topic, and there's a lot more. I do not have a CPA. I'm not there's a lot of tax and tactical type questions as it comes to this, but I think as you look at SPVs and just getting started into investing, these are the things that you want to keep in mind from the highest level and continue to build through that. So that's
Great. Well, this has been great.
absolutely.
Thank you. Do you mind
Thank you.
jumping to the
Yeah.
next slide? Yep, because there's a QR code there. If you are not already a Jane, please consider becoming a Jane, and you will get access to more events like this. You'll be part of our newsletter, and we'll give you other opportunities to learn about venture. So thank you so much. Um, Thanks, Matt. We're going to be blasting this video all over the socials.
All right. I'm glad I wore a collar shirt.
Yeah, you did great. Thank you so much, everyone. Have a wonderful rest of your day.
Thank you, Matt, Valley, and Caitlin.
Bye.